Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. US and European equity futures shake off geopolitical concerns while Asian indices dip as markets stand by for highly anticipated earnings from chip powerhouse Nvidia. Global leaders failed to present a united front on Ukraine and the Middle East at the G20 summit. Russian Foreign Minister Sergei Lavrov says Moscow will react to Kyiv's recent attacks accordingly. And Donald Trump's search for a Treasury Secretary continues, but Howard Lutnick is out of that race as the President-elect confirms the Cantor Fitzgerald CEO as Commerce Secretary.
Let's talk about these markets. As Anna says, it is Nvidia day, but that comes later. In the meantime, European futures are a little bit higher. FTSE futures a little bit lower. The one you want to watch out for this morning, folks, is this one down here. Euro Swissy. Yesterday, big move around the nuclear threats coming out of Russia. We've retraced all of that. In fact, the Euro Swissy is now up on where we started this whole process. Looks like the Russians may be prepared to talk. That's the Reuters report this morning, and that is seeing the euro gaining a little bit of traction this morning. The countdown to the opening trade starts right now. Wednesday the 20th, good morning. It is Nvidia day, but we're going to have to wait. That comes a little bit later on in the morning. In the meantime, we've got some data that we need to be digesting out of the UK. CPI dropping onto our screens.
Yeah, absolutely, Guy. And it comes in a little hotter than had been expected. Not by a huge amount, but that's the nervousness in the markets being reflected there. And we see that the pound is responding accordingly. So the pound goes higher as we get a CPI year-on-year print that comes in at 2.3% against an estimate of 2.2. And importantly, the services number, psychologically, does it matter? It's over 5. So 5% is where we are on that number. And we had expected 4.9. So that, you know, the scale of the miss, if you like, or the higher than expected number is not big, but these numbers are pushing in a direction that the market is nervous, especially after the budget, nerves around just how quickly can the Bank of England cut interest rates.
The signal from the Bank of England is that it's going to be gradual. That's certainly the message that the governor has been delivering recently. The 5% is bang in line with where the Bank of England in its forecasts anticipated that services number would be. So as you say, we're not particularly off course here, but the direction of travel is maybe a little bit harder to read now, and certainly this disinflation process that we've been having unfolding in the UK appears to be, again, maybe a little bit more gradual than we had anticipated.
Yes, and when the global conversation is all about that same thing, certainly the other side of the Atlantic, it's about a new administration coming in and just how inflationary is that going to be, then that adds to that nervousness in the UK, doesn't it, around just how many cuts the Bank of England will be able to do. Interesting that Bailey also warning against trade protectionism yesterday, and this is going to be something that we hear from small, open economies a lot more of.
He's also warning that the recent government budget is likely to mean that the Bank of England is less likely to cut rates at a frenetic pace. He's basically signalling that he's waiting to watch and see particularly what the national insurance contribution effect that has been put onto corporations, companies, is going to have. Do they raise prices? What do they do in terms of the labour market? He wants to wait and see to get a handle on what is happening here.
Yeah, and we're going to speak to a UK business later on that has things to say about the scale of the impact of that. Interesting that Bloomberg Economics is talking about that slow easing of policy. They see a hold in December, and then coming at quarterly cuts is the pace of change that they see. So that's Bloomberg Economics on the Bank of England.
We'll hear from them a little bit later on. I think Anna Andrade is going to be joining us. Anna mentioning as well that we're going to be hearing from Sage. Let's talk geopolitics. The G20 was a bit of a mess. I don't know why anybody is surprised by this. This is too big a group to have a single view on what is happening in a very disputed world right now. You've got what's happening, obviously, in Ukraine. You've got the situation evolving in Gaza. There's other factors coming into the mix as well. Plus, you've got to plug in a Trump presidency, which we have no idea what impact that is likely to have. You have a lame duck presidency in the form of the Biden administration, basically pulling on a series of strings as well. It's reasonably chaotic out there. The G20 is way too big a group to have a common view on what is happening with all of this.
Yes, and it's not helped by the fact that all the members of the G7, if they were in a position to lead this group at any point, you know, many of them are either on their way out or they're really new in the role. And so you're lacking that kind of cohesion. I do think we're getting kind of mixed signals, though, because the lame duck element is really interesting. Lame duck might lead you to think, well, nothing happens. But actually, we've seen a lot happening deliberately because we're in this lame duck phase. You know, reference Biden allowing ATACMS to be used in, deep into Russian territory. That's one of the dynamics. This time yesterday, we were just about to be jolted in markets, Guy, by all of those headlines around ATACMS use and what that would mean to the reaction function from Russia. Timothy Ash spelling it out quite nicely, saying that this all adds up to a reason to escalate before talks, before Trump comes in. And interesting in that context that we're seeing some contradictory guidance this morning from Reuters talking about Putin being open to talks on a ceasefire.
Well, is it contradictory or is it just logical, as Tim lays out? You've basically got a situation where Russia is putting the nuclear card back on the table before the talks take place. You want to basically be on the front foot going into those talks. He's basically escalating into the talks, which Tim says maybe is his normal sort of modus operandi in terms of the way that he approaches these things.
And I would have thought those happened sequentially, but maybe they happen in parallel. Yes, maybe they're happening exactly at the same time. And we've seen the US Embassy in Kyiv taking action because they've had some intelligence around an attack. So maybe we are seeing both of those strands, the escalation and the talk of the ceasefire, all at the same time. Guy, we do have Nvidia to talk about.
We're bearing the lead a little bit.
We are a little bit, aren't we, in terms of the market sentiment and what is driving that. Really interesting that Barclays talking about the options market, saying that actually it's the Nvidia move that is seen as bigger in markets, bigger than the Fed in December. It's the moves that are built into the options market around this earnings story that are bigger than that. So that sort of sets up the stakes. And I mean, this is a stock that's up 197% year to date. It's had incredible gains. It tells a story that is very detached from the US politics, and lots of other asset classes have been very much hanging on the US politics. So we'll see where it takes us today.
Strong into the numbers, which is interesting as well, the fact that the market bid up their stock going in. The market feels like, if you look at a number of metrics, there are a number of metrics to point to the fact that the market maybe is overbought at this point in time. And you do wonder, therefore, if Nvidia takes on an even greater level of importance in terms of the effect that it could have in terms of people's portfolios. So it's going to be really interesting to see just how much volatility we get around the numbers a little bit later on. We'll be talking about them this time tomorrow,
yes,
certainly.
Absolutely. I mean, Jen-Hsun Huang talking about the demand for the Blackwell chips being insane. That's the actual word that he was using. So that really sets up the stakes, doesn't it? We were just showing a graphic that showed the incredible transformation of this business from a business that obviously we know used to supply predominantly gaming companies to one that supplies data centres and AI, and the change that we've seen in that business and the impact that is going to have on businesses globally is still one that we sit back in awe and watch.
We are certainly, watching in awe. And you do wonder what effect it's going to have going into 2025. Is this something that can be sustained? We're going to find out a little bit later on. We've got some great guests today to talk about all of this. Mortier, Amundi CIO, is going to be joining us as well. Ipek Oskar Deskaya, senior analyst at Swissquote, joining us as the opening bell comes through. Kirsten Braathen, CEO of Norwegian lender DNB. Capital Markets Day yesterday, looking at rates coming down. Have you seen Norwegian rates? They're incredibly high at the moment. This is a country that is dealing with significant inflation, so we'll factor that into that conversation as well, plus also geopolitics relevant for what's happening in the Norwegian region right now. And Nathan Sheets, Global Chief Economist at Citi, is going to be joining us. Really interesting report that he's got on what is happening in the defence space right now, where defence spending is ultimately going to be going. Yeah,
absolutely. That defence conversation ongoing. We'll get back to that. Here's what we're watching for then today. 10 a.m. This morning, the ECB publishes its euro area negotiated wages data, so that could be something that the market wants to focus in on. After the bell, of course, we'll get those Nvidia earnings, and the ECB's Lagarde is going to speak. The Bank of England's Ramsden will be speaking, so we have a host of central bank voices, I think some Fed speakers later on today. Now, what we don't have in there, because we can't put a time on it, is when on earth will we learn about the Treasury Secretary and who that is going to be, Guy. And I wonder to what degree surely the market will care who gets it, but if it is between Walsh and Rowan right now, you'll find voices who care very much one way or the other. But for Wall Street as a whole, does Wall Street just see either of those as people they understand and who will understand them and therefore not worry too much?
Well, they are Wall Street, aren't they? They are speaking...
They're guys.
Precisely. Yeah. And it's interesting that Lutnick's out. He's going to take on commerce, but he's taking on commerce with a greater mandate, with a greater emphasis on what is happening with tariffs and trade, which is interesting. So you do wonder... do we need to place such emphasis on that part of the equation when it comes to these two candidates? Are they going to be required in the same way that they would have done to lean on the Treasury, to lean on the tariff route that Trump so wants them to do? Yeah,
absolutely. And it just shows how important the tariff policy is going to be. The fact that Lutnick, I assume, has pushed for this and wanted to have more influence in this particular space. It is interesting because then will we see the wings clipped of some of the other roles that sit at the top table in the White House? They have a trade representative. how does that rub up against an expanded role for the Commerce Secretary?
Yeah, and where does Lighthizer fit in?
Yes.
Does Lighthizer fit in? I think it's a question that
yeah.
everybody's now wondering. What else you need to know this morning? Let's run you through some of the other top stories we're focusing on here at Bloomberg. SpaceX says its Starship rocket has achieved new goals during its 6th major test launch, but the company scrapped plans to catch the booster with mechanical arms. The Super Heavy rocket performed a controlled landing in the Gulf of Mexico, and the Starship capsule survived re-entry into the Earth's atmosphere. US President-elect Donald Trump was at the launch alongside his new friend, SpaceX CEO Elon Musk. The UN nuclear watchdog says Iran has agreed to stop enriching uranium to close to levels needed for weapons. The IAEA monitor says Iran's engineers are taking the first steps needed to cap output of 60% enriched fuel. That comes after talks in Tehran this month between the agency's Director General and Iran's president. And the former Hong Kong media mogul Jimmy Lai has taken the stand to defend himself against national security charges in a case being closely watched in Beijing and, of course, the West. In his testimony, Lai dismissed the idea of advocating independence as, quote, crazy, and also downplayed his foreign ties.
Coming up on the programme, Vladimir Putin reportedly rules out territorial concessions, but says he is open to ceasefire talks with US President-elect Donald Trump. We will break down the latest that is moving markets and get up to date on Ukraine. Plus, the Grifols board says it won't back Brookfield's bid, saying it undervalues the company's prospects and potential. And a conversation with the Sage Group CEO, Steve Hare, will be joining us. We'll talk about the results. We'll also talk about the operating environment in the UK and, importantly, in the US. A substantial part of the business for this tech company comes from the United States. If you have any questions for our guests, if you want to get in touch with the team, please do. You can send us an IB. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
"44 minutes to the opening trade here in Europe this morning. Let's talk about the big event that comes a little bit later on in the day, and that, of course, is the Nvidia numbers. Take a look at what's happening in the options market. What you're seeing there is suggestive of the idea that we will be seeing a major event for markets later. Basically, you're looking at a bigger catalyst potentially here than we've seen coming from the Federal Reserve. That's coming from Barclays Strategies. Let's get more on this. Valerie joins us on the news.
Yeah, exactly, Guy. Tonight's earning results from Nvidia could be the last major market catalyst as we head into the end of 2024. It's notable there has been a lot of optimism heading into these earning release from Nvidia. The stock jumped near 5% in yesterday's session on no new news, just optimism ahead of this release later tonight, expected to come around 9 p.m. London time. But that move in the stock yesterday, Guy, had Nvidia very, very close to all-time highs. And it's warranted to take a step back and just compare how Nvidia's stock price is traded versus the wider semiconductor industry. We have Nvidia very close to those all-time highs, but the wider industry surely is not. It is down over 30% from the highs that we saw in late July, the broader semiconductor industry, that is. So there is a lot of pressure on these results tonight. It goes to show that Nvidia itself, analysts expect that 25% of the entire S&P 500's third quarter earnings growth to come from this one single stock. Now, it could also point us in the next direction for the S&P 500, given its massive weight in the index. We flip on and just show how the positive momentum in the S&P 500 has waned since the outcome of the U.S. election. It could all be up to this stock results tonight to point us in the next direction. So we have had some positive momentum on the stock market fading. We've also seen some positive momentum in the dollar fading. We had the dollar hitting the highs that it's not seen in the last 2 years, but a lot of that has come off in the last few sessions, Guy. We're off nearly 1% from those recent highs. Even those geopolitical angst of yesterday weren't enough to keep the dollar stronger on the session. It was weaker by the close in yesterday's session as well. So eyes on that dollar strength and eyes on these Nvidia results tonight.
Absolutely. Two key events that we're going to be watching out for. There's a lot to fold in right now. Valerie, thank you very much indeed. We're joined by Mortier, Group CIO at Amundi. Vincent, great to have you on the programme.
Morning.
These are really difficult markets to read right now. Give us a handle on how you're seeing things developing. We've got a number of different forces that are coming into play. We still don't know what the Trump administration is going to be delivering. How easy, without that kind of steer from what the next White House is going to look like, is it to predict what 2025 is going to be looking like?
Yeah, hello, Guy. Indeed, we are in a very peculiar environment where lots of optimism has been built into US assets at large, and very crowded trades have been put together. And the Trump trade has been very powerful, and it will last for a few weeks, we believe. Other asset classes have been suffering, and maybe too much negativity has been built in some parts, Europe typically. And so we are in a world of anomalies. So we've got top 1 or 2 percentile valuation levels in the US, not only Nvidia, the broad market, even if it should surpass the Magnificent Seven, a very concentrated market as well. Credit spreads for corporates in US have come back to 2007 level, which are super low. And there are many other metrics that are showing that we are at extreme levels, retail participation as well in US, in particular on tech stocks. So all this, I mean, is great. I don't say that the US is going into much trouble, and Trump will probably be positive for corporates, but nevertheless, maybe it is too extreme on the one hand, and too negative on the other hand for some markets. So that's why we are navigating to reallocate some money.
Vincent, the issue is, though, that there's no obvious catalyst to end it. And the market story continues to be broadly positive. You've got enough money coming into the market. Yeah. You've got an EPS story next year, which is probably good enough. You don't see a recession. Is there an obvious catalyst to unwind some of these extremes that you flagged?
Yeah, indeed, what we see is that the market is not at all ready for any kind of comeback of inflation in the US. And the likelihood of some bad surprises on inflation in the coming months and quarters is increasing day by day with the Trump agenda and the nominations. So that's something to watch, because the market is not at all pricing this. As well, you mentioned earnings. I mean, earning growth for next year for the consensus is 15% in the US on average. We are more in the 7 to 8% camp, and we believe the market is too optimistic regarding earning growth. And we need also to keep an eye on the GDP growth. So soft landing is still our core scenario. But if you have at the same time a spike in inflation, let's say to 3-4%, and a deterioration of the job market in the US, then the Fed will be caught into a very, very complex equation to solve. So either to continue to cut or to pause or even to hike again. That's a possibility.
Yes.
And the market is not at all prepared for it.
OK, so Vincent, so we're not really pricing in enough of that inflation risk. Thinking about some of the other dynamics that the market is dealing with right now, our colleague Valerie was talking there about Nvidia, reports later on today. There's a lot at stake, as always, with this business and these earnings. Last quarter, the message from Nvidia and the wider sector seemed to be the AI theme very much intact. The semiconductor sector, though, more broadly, not such a bullish story. Are you investing with that dynamic in mind?
Yeah, I think we are coming in a more mature phase of the market in terms of AI. Now, the big question mark regarding Nvidia is whether they will, the figures to look at tonight will be the margin levels and the market share levels. Because $3.5 trillion of market cap and price-earning ratio of Nvidia today can be justified only if they can keep their market share intact and also their margins intact, which is questionable in a context where more competition is coming. Demand is still here, for sure, but what we can see from competitors here or there is more and more investment to compete with Nvidia. So the broad sector is still intact. The value dispersion between players in the sector can be more questioned. But I mean, Nvidia, like a few other stocks in the US, is a darling of retail investors. The volumes traded are just insane. And so it's a momentum stock by nature today.
OK, so we watch for those dynamics then, Vincent, when we get those numbers. I wonder what you're watching for on the geopolitical front as well, Vincent, because we get mixed signals, perhaps deliberately mixed signals at the moment. On the one hand, plenty of signs of escalation towards the end of the Biden administration as we head towards another Trump administration. On the other hand, talk of talks, a conversation about whether we will see peace talks. So what are you watching for geopolitically to sort of set that agenda for you into 2025?
Yeah, so geopolitical will continue to be a key topic for next year. So far, investors have been not really discounting it that much. We think it will make a comeback. It's not only negative, actually, because one of our catalysts for next year of positiveness is a ceasefire and a peace in Ukraine, which will be very positive for Europe, naturally. US-China tensions will continue, for sure. But it will be a tough negotiation. Both camps having some arguments to make it happen. So it will be a kind of game. At the end of the day, we believe that each parties will come to a reasonable agreement. But short term, it can bring some volatility because there will be some big announcements, some headlines. So we need to monitor it. But I mean, overall, geopolitics can be actually a better than expected surprise next year, even though we can never discard some extreme outcomes.
It was amazing yesterday just how quickly the market round-tripped and dismissed all of the talk of nuclear escalation. So, Vincent, what do you do at the moment? Do you stay invested? You've laid out a number of risks that could potentially materialize. You see US stocks are stretched, you think credit spreads are too tight, you think inflation is being underpriced and earnings are being overpriced. But what do you do? Is it a reason to get out of this market, particularly the US market, or do you have to stick with it and hold your nose and hope that nothing upsets the apple cart?
Now, overall, in terms of risk exposures, we are not underweight, we are just equally weighted. So it's just a question of rotation and allocating money to other areas. So basically, we believe that some parts of the European markets are now quite cheap. So we put money at work here. We still like Japan as an investment case. There are still lots of value to be unlocked in Japanese corporates. We still like South Asia. India, after the pullback, is back to be interesting. Indonesia, for example. China, it's a big discussion, but we continue to see it medium long term as a good potential. And we still have a core allocation to govies, in particular US Treasuries, at 4.4%. We believe it's fairly priced, and the carry is quite interesting. So we continue to make rotations. So the UK as well. I mean, it's not. We are slightly overweight the UK for the time being. So it's more a question of selectivity and reallocation and agility, because volatility will increase. On rates, it's already very high, but on equities, the volatility will probably increase again.
Thank you very much, Vincent. Vincent Mortier, the Group CIO at Amundi, talking to us there about some of the anomalies in European valuations, looking there. Also, keeping agile amongst all of this volatility, likes Japan as well, and has a core allocation to govies as well. We will continue to talk about these markets, of course. We will take a deep dive, though, into the tech themes. We're going to be talking to the Sage Group CEO, Steve Hare, on the FTSE 100 enterprise software companies' earnings. We will also talk about the impact of the UK budget, any clues he has around the UK macro space, also has a foot in the US, of course. All that up next. This is Bloomberg.
Good morning. Good Wednesday morning. 29 minutes to go until the start of European trade. So futures look a little bit like this. This is the picture. You've got US futures basically doing nothing. Now, the US session yesterday, we sort of climbed gently into the close. We've got to price that in this morning into Europe. That's why you're seeing maybe some outperformance coming through from European markets. In terms of what we're also seeing, you're getting this Euro-Swiss story develop, which I think is really interesting as well. So look at the two-day chart. You get this drop in the euro, which is when we were all very concerned about this nuclear talk, the nuclear commentary coming out of Russia. We've pretty much round-tripped all of that. The market as ever, seems to blow through geopolitical events very, very quickly. And this morning, we've got news coming out suggesting that maybe actually Russia is prepared to talk about Ukraine, and as a result of which, you get another spike higher in the euro. So that's the picture at the moment. Futures are broadly positive, but the reason for that seems to be we're waiting for Nvidia. We're also kind of looking out to the idea that maybe we get some sort of a Treasury Secretary story developing, but this feels like an arbitrage story this morning.
Yes, it feels like we're still kind of turning the corner from yesterday a little bit here in Europe, aren't we? We did it in the United States. Sentiment improved through the day, and it did a little bit here yesterday as well, but maybe we, as you say, need to work in some of that turnaround away from that risk aversion that we saw early on in the European session. We need to continue doing that. And we see that in the bond markets as well. So yesterday was characterised by a pile into some of these havens. So money went into bonds, it went into gold, it went into some of the Swiss franc and things that Guy you just mentioned. But today we see something different, a bit of selling on the European bond markets and those yields just ticking a little bit higher. We see US yields going a little higher this morning as well. And all of this in the context of this sort of ebb and flow of headlines that we've had around Ukraine over the past 24 hours.
Yeah. And the market really struggling to deal with that. So the latest this morning is that Russia's Vladimir Putin is reportedly open to a ceasefire deal and that he wants to talk to the US President-elect Donald Trump. Now, how much of this is really news? I'm not entirely sure. The news, though, does come after Ukraine took advantage of its newly gained long-range missile capabilities yesterday, hitting a military base in Russia. Moscow stepping up its threats of a nuclear response to such conventional attacks, and that's kind of where we are this morning. Let's bring in Bloomberg's Oliver Crook to try and analyse all of this. Ollie, walk us through the choreography here and whether or not in some ways it makes logical sense.
Yeah, so listen, Guy, there's so much news flow to unpick over the last 2 days, and when sort of some of that news flow, includes nuclear doctrine from Russia, the markets can get really pretty spooked. Let's just begin with what we got this morning out of this Reuters report with a lot of caveats saying that this is obviously Reuters reporting here. They're citing 5 unidentified current and former Russian officials. But if this is in fact true, this is a very significant development, saying that Putin is open to talks over the ceasefire deal with Donald Trump. And what is most significant about these sort of developments here and the information we have here is we're starting to get some actual contours around what this actually means. He's talked about in the past that they need to sort of come to grips with the new reality of the geography of the region. But what he is saying here is that he's open to negotiations over a carve-up of the 4 regions of Donetsk, Luhansk, Zaporizhia, and Kherson. He says also, according to this report, that Russia may be open to withdrawing from smaller patches of territory in Ukraine. Putin still, of course, opposes any sort of potential path for Ukraine to join NATO, also saying that the sort of decision from Joe Biden to provide the attack of missiles may sort of complicate things. We should say the big caveat here is that these kinds of talks are still very, very far in the future, potentially. That being said, if you start to sort of stake out the positions on this, that is a significant development. We have not had very sort of clear contours from the Russians until now, if this report is correct. We should also say that though these sort of talks are some distance away, Trump sort of breathes some real uncertainty on this, and it may blow up any sort of idea of timeline that we have going forward here. So I would say these are some meaningful developments.
Yeah, really interesting, because we have heard Putin say before he's open for talks, but as you say, this report does seem to go further, so we'll wait for more clarity on what that really means. And so we end up in this situation where we see escalation from Russia and also talk of de-escalation all at the same time. In the midst of that, Ukraine then, using its new capability, granted the ability by the US to use those ATACMS on Russian soil.
Yeah, and to sort of unpick everything that we got in a very sort of short order yesterday, we had the sort of first strikes of the Ukrainians with these ATACMS within Russian territory. Why this took so much attention and really sort of threw the market yesterday was first because these first strikes within Russian territory were not in the Kursk region. There was some understanding from the early reporting that what Biden had let the Ukrainians do was to strike within the Kursk region. This was a bit further afield, further within Russia. That was the concern number one. The other concern was the fact that Russia then signed this new sort of nuclear doctrine, and this I'll quote more precisely because the wording is very important, saying that Russia will view an attack on its territory by a non-nuclear state, i.e. Ukraine, that is supported by a nuclear state as a sort of joint attack, right? Not drawing the distinction between these two things, and basically saying that the new doctrine would allow the Kremlin to respond to such a situation with a nuclear attack. This, of course, really concerned the market. And when we sort of groped through the darkness of war for where these red lines were, yesterday there was a real moment of fear within the markets that we might be approaching one.
Ollie, Olaf Scholz is saying that he doesn't want to send long-range weapons to Ukraine because he feels that the German public is not behind such a move. What does the German public actually think?
Yeah, so Guy, there's some sort of division in here, and there is at least some more nuance to it. What we should say is that the mainstream political establishment in Germany, apart from the SPD, this is not just an Olaf Scholz position, this is an SPD position. They do not want to send these long-range weapons. They are very sort of reticent to escalate anything. The reason that this is significant, Guy, is because basically what has happened since the beginning of the war is that Germany has moved sort of in lockstep with Joe Biden. So when Joe Biden says they'll send tanks, the Germans say they will send tanks. That has now changed. I spoke to a lawmaker yesterday saying that they may actually bring this vote to Parliament in defiance of Olaf Scholz. Have a listen to what he had to say.
The majority of current members of Parliament in Germany and even part of the German government, except Chancellor Scholz, are supportive of the delivery of the Taurus missile. We need to accept that only firmness and strength is respected ultimately by Mr. Putin. And he is testing our willingness really to be firm on the issue. And so I think we should be.
And so that conversation was just sort of an hour or two after we got that sort of news from Putin about the nuclear doctrine. And really what is interesting is that there's this election in Germany on February 23rd. This could be one of the last agenda items to go through the Bundestag. And according to Florian Tankar, the lawmaker there, they could potentially pass it in defiance against the sort of will of the chancellor.
Oliver, thank you very much. Bloomberg's Oliver Crook. Yeah, really interesting to see the position of Germany in relation to the United States evolving. So too the position of the UK, really interestingly. According to our reporting, Keir Starmer stopping short to some degree of really giving whole support to what America is allowing the Ukrainians to do, despite the fact that the UK had already allowed some of its weaponry to be used in Russia. Let us pivot from UK politics then onto the UK corporate scene. The UK software company Sage Group has missed full-year estimates for key North America revenue, but has forecast at least 9% organic revenue growth for 2025. Joining us now is Steve Hare, the CEO of the FTSE 100 enterprise software company Sage Group. Steve, very nice to speak to you. Good morning. Thank you for joining us. I wonder what the outlook for the business looks like to you. We're talking this morning about a whole host of uncertainties, areas of volatility in the market, geopolitical tensions, all sorts of reasons to be cautious. How much visibility around the outlook do you have for the business of Sage?
Yeah, good morning. I mean, I think that we've delivered the third consecutive year of double-digit recurring revenue growth. And I think what that's done is, you know, we're carrying strong momentum into the current financial year. And actually in our guidance, guiding to at least 9%, we are being a little bit cautious because our current run rate's a little bit higher than that. But we want to take into account some of the headwinds that you're mentioning.
Steve, good morning. It's Guy. OK, so let's talk a little bit about that. So you're at 9% now. You say you're being a little bit cautious in terms of the guidance for 9% going forward into next year. What gets you north of 9% next year? What do you need to do?
Well, at the moment, I mean, half our business is in the US, and the US actually grew about 12% in this financial year. So, you know, we see pretty balanced growth. We're seeing some increasing growth in Europe, which is a little lower than the US. So I think, you know, if we continue to see the balanced growth across all of our geography and all of our products, you know, I would hope we'd do a little bit better than that. But, you know, as you say, we are being a bit cautious because there's still quite a lot of uncertainty in a number of our markets, including the US.
Steve, one of the pieces of data that I follow most closely is the NFIB survey out of the United States, the survey of small businesses, many of which will be your customers. It came down this year. It's sort of been bouncing along the bottom, but it's now showing signs of picking up. Do you anticipate with the Trump presidency that small business optimism in the States continues that trend? Would that be something we should look forward to into 2025?
Yeah, I mean, we've recently done a survey of 12,000 SMBs around the world, including North America. And our data would say the same thing, that generally small, mid-sized businesses are optimistic. They like certainty. So the fact that we've had, you know, political elections both in the UK and the US, but that's now done. People know what they're dealing with, and I think that means that they will approach the coming year with optimism, albeit they've got some pressure around rising costs. But I think, you know, small businesses have got track records of dealing with that, and they look forward with optimism.
Yes, Steve, just focusing in on the UK side of that. I mean, you mentioned there that businesses like certainty, and they got some of that in the election result, but then that was met with some uncertainty around the budget and now higher taxes in the shape of the national insurance employers' contributions. How are you as a business managing that kind of step change, and how do you see your customers managing it?
Yeah, I mean, for us, we will seek our own sort of productivity and efficiency to deal with any cost pressures. We employ about 3,000 people in the UK, but we employ 8,000 people outside the UK, so we have a pretty balanced cost structure around the world. And what we're doing with our customers is really focusing on delivering them products that save them time, give them productivity, and hopefully therefore help them to free up time to focus on growing their own businesses and dealing with their own pressures.
Talking of the new government, you have called on the new government to issue a digital strategy quite urgently, Steve. What do you need from government on that front, though? Is that something that business can't just get on with? We see plenty of businesses engaging in a host of new technologies right now, AI being one of them. But what do you need the government to do? What are you asking for?
Yeah, we're investing heavily in digital tools, including AI. We've launched our own AI digital assistant, Sage Copilot. But what we need government to do is provide the framework. And I think e-invoicing is a very good example of that, where across Europe and indeed much of the developed world, there are set out standards for e-invoicing, which means that when businesses interact with each other, they're doing so to the same standards. And we really need the UK government to sign up to that so that when people are trading cross-border, it's all on a consistent basis.
Do you think AI is making you money yet, Steve? When does it make money? As you say, you're rolling it out across some of your products. You give a little chuckle. What do you think the answer to that question is?
Well, the way we're using AI, we've been embedding AI in our products for many, many years. The reason for the smile is what's changing is generative AI. So as I say, we've launched our own Sage Copilot, which is a digital assistant for small, mid-sized businesses. And we're in the process of embedding that in some of our offerings. And I think we're kind of different from a number of the bigger players who are investing very, very large sums of money in these very wide large language models, very wide AI. What we're doing is really focusing down on accounting, payroll, HR, compliance. So we're actually local domain expertise to deliver real-world solutions to our customers that save them time and deliver them insights and productivity. So give them, that real boost to their own productivity.
Give us an example of what does that really mean on the ground, Steve? What are your businesses able to do now that they couldn't? Because, we've seen such a frenzy around AI, and the constant question we ask is, is it going to live up to expectation?
Yeah, so a very simple example would be, just chasing down overdue debts. So small businesses spend a lot of time chasing their customers to get paid. And so you can use a digital assistant, for example, to just ask very straightforward questions. Tell me who owes me money. The assistant will draft you an email, send that email to your customers for you once you've approved it and edited it so that you're happy with it. And then when you get up the next morning, it will tell you who's paid. So it's like having an additional person to support you and do a lot of fetch and retrieve, pull information for you, and basically help you automate a lot of your processes. Because humans spend a lot of time just moving and chasing things. And what we're trying to do is make it very human-centric so that we're elevating what humans do so that they can spend time running their businesses instead of doing admin and chasing paperwork.
Steve, one of the concerns that certainly we hear a lot from small businesses is the level of regulation. The British government, other governments are talking about deregulation. Do you believe that's going to happen? How high is the regulatory burden right now?
I think where it's at its most acute is often in cross-border trading, and it depends what industry you're in. But again, most small businesses I speak to, they're looking to remove friction, they're looking to remove barriers from what they do, and if they have to comply with lots of different standards, and so produce products which comply with different regulation, different standards, that's a barrier that stops you trading in a seamless way. So I think, the more that governments cooperate together to create the clarity so that people can trade seamlessly across border, I think that's what we're looking for. And it's similar with the e-invoicing. That's why I keep saying to the UK government, you've got to try and do the same thing as everyone else. Don't come up with your own regulations, because that just gets in the way.
Yeah, we've seen maybe some evidence of trying to do things differently, going awry. Steve, great to speak with you. Always a pleasure. Thank you very much indeed for joining us this morning with your numbers, full year numbers. Steve Hare, the Sage Group CEO. OK, we're going to get back to the markets in just a moment. 30 minutes till the market open. We'll see how Sage opens. We'll see how these markets open when we get to that. We'll do that in a few minutes' time. This is Bloomberg.
Welcome back, everybody. This is the opening trade. We are 10 minutes away from the opening trade here in Europe. The Asia session has been a negative one. Let's catch up, though, with Paul Dobson, Bloomberg's executive editor for Asia markets, who can talk us through these markets in 3 minutes. And, Paul, I wonder if, the Asia story may be telling us the story of yesterday here in Europe. We're trying to look ahead here on European futures and US futures to the Nvidia numbers. That such a huge spectacle, I suppose, that hangs over these markets.
Definitely, Anna. Good morning. That's what everybody is waiting for. Every 3 months I get to come up here and have the privilege of talking to you in the morning. We say, whoa, this is the big one. Can they meet those lofty expectations? The market's expecting another blowout. And most of the time they have done, and it's continued to accelerate and grow and show those big numbers. Even though if there's been some disappointment, the stock has still roared back again. So, the company just has such a strong impetus behind it. The market will be looking out for, yes, profit, but also just revenue and customer CapEx numbers, what its future earnings growth looks like, and any updates on the new chips that it's developing and those temperature problems that have been discussed in recent days. It matters because it's such a huge weighting in the index, more than 8% of the S&P. It's also that bellwether for the rest of the tech industry and for the AI narrative as well. So a lot riding on it, and it will be pretty decisive for the direction of markets over the rest of this week, most likely.
Is the video going to be more important than the Treasury pick? Give us a sequence.
Well, what I think is really funny, we all like this stat showing that the options market, at least for stocks, is pricing in bigger swings off the Nvidia earnings than it is off the next Fed decision. I think the Treasury pick is going to have bigger global market implications overall, right, Guy? And the market is looking forward to the idea that it could be Kevin Walsh who is successful. He's being seen as a little bit more of a safe hand, a little bit more of a person that would know what the risk of a bond market sell-off looks like and how that could play out. If we do get confirmation of that, it's likely the market would take it as a positive.
Yeah, meanwhile, Paul, we've seen markets very nervous around geopolitics. It's certainly shifted back onto the agenda, the conflict in Ukraine. We saw yesterday the yen gaining on that front. Today, the yen loses ground on that front, along with a host of other perceived safe havens.
Yeah, I did think that was an interesting reaction, given the yen really hasn't performed very strongly as a haven currency over the past year. But when we saw those news headlines breaking, the first reaction in that panic was for people to buy the yen. I think the yen has a short-term story and a longer-term story playing out here. In the short term, it remains under pressure. The strong dollar is the overriding narrative. But more and more people are looking forward to further yen strength over the year ahead, in particular juxtaposing that against the euro with the idea that the ECB is going to have to cut interest rates quite aggressively, and the Japanese central bank will continue to raise interest rates slowly. So euro-yen seems to be one of the favorite trades for the year ahead.
Paul, great stuff. Perfect timing. Thank you very much. Paul Dobson, Bloomberg's executive editor for markets out in Asia. Let's figure out what is happening this morning here in Europe as we approach the equity market open. 6 minutes away. Joe, what do you got?
Morning, guys. So we're not watching at Nokia today after the company fell around 5.7% yesterday following an analyst report that the company could be about to lose a big contract with T-Mobile US in the States. Now, the stock fell by 5.7%. That was the biggest drop since a year ago when the company lost a contract with AT&T. And actually, the analyst that made the prediction yesterday also predicted the AT&T contract loss as well. JP Morgan analyst, therefore, writing in a note that if this was to come to fruition, that would potentially mean the turnaround of that unit had potentially failed. So definitely one in focus today. Then in terms of M&A, we're looking at Rubis. This is a French fuel distributor. Bloomberg reporting that the company is considering options, including a potential full sale. That stock had a big jump earlier this year when they offloaded a part of their joint venture business, but on a long-term basis, it is down sharply, potentially spurring those predictions of a sale at the company. Finally, in M&A, we've got Grifols on the radar, saying that the latest bid from Brookfield has undervalued the company. It was at $10.50 a share. We can see that stock really slammed following that recent report from Gotham Research. And in ratings, some decent ones today. The one that's caught my eye, AstraZeneca upgraded at UBS, a long-term seller. We've also got rating changes for Wholesome and EasyJet cut at HSBC today.
Joe, thank you very much. Our equities reporter Joe Easton with a look at some of the latest lines out of Nokia and other businesses. Nokia also talking about a 5G extension deal with Bharti Airtel. More on that shortly. The Open is next. This is Bloomberg.
Wednesday morning, good morning. Minute or so to go until the start of trading here in Europe. Let's talk about what we get out of yesterday's US session and how that factors into this Wednesday morning here in Europe. Europe pricing some of the rally we saw yesterday in the States. It was a gentle rally in the afternoon. We've still got a little bit of catch up, maybe to factor in to our thinking this morning, though we are clearly waiting for seeing what Nvidia is going to deliver, but that comes much later on in the day. So there's a little bit of a trade that we need to price in from the States. That's probably why most European futures are pointing a little bit higher this morning. You've got most of the main markets up by 6, 7, 8 tenths of 1%, which is a decent bounce. Eurostock futures 8 tenths, CAC 40 up by around 6 tenths of 1%. The FTSE looks like it's a bit of an anomaly this morning. There's a number of stocks that are reporting numbers this morning. We've already talked to Sage. You've got British Land out as well. It's going to be interesting to see just what maybe provides that underperformance from the FTSE in today's market, because in some ways you should expect the kind of catch-up maybe to be a little bit more consistent, Anna.
Yes, well, it's interesting. We don't have any standout performance to the upside from some of those basic resource underlying metals, so maybe that's enough to weigh on the FTSE 100. Let's talk about some other stocks that could be in focus, as the basic resources sector might not be, setting the direction of travel higher in London. Let's have a look at where we are on Nokia. The interesting story here, as we were hearing from Joe, down by more than 5% yesterday on reports. Could it lose contracts over in the United States? But then they've come out with this news around a Bharti Airtel deal this morning. So how much does that offset that concern? Grifols in the biotech space, that's an interesting one. The board recommending that shareholders reject Brookfield's offer for the business. And Stellantis also in focus, delaying the launch of its 2 electric pickup trucks. Guy?
Let's talk about this market open. Here we go. It is time for the opening trade here this Wednesday morning. Nvidia Day in the United States. We'll wait for that a little bit later. So the early indications are London is higher, but is expected to underperform. We're maybe seeing some evidence of that already this morning. The IBEX is out of the gate up by around 0.5%. So already a little bit of a gap in terms of the performance picture. The Stock 600 is up by 0.3%. So we are getting this anticipated London underperformance. The CAC 40 and the DAX still yet to open. Interesting little stats. You put the CAC 40's market cap to the side with the DAX's market cap. And you're just a little bit ahead of Nvidia's market cap, Anna.
Right, yeah, that really does set up the stakes, doesn't it, for later on when we get those numbers out of Nvidia. In the meantime, what do we do on these European equity markets? Well, we go slightly higher, a little bit of a catch-up, as we've been talking about, with the United States and the trade there yesterday. And all sectors, in that modest catch-up that we're seeing across Europe, all sectors are in positive territory. Not all geographies. The FTSE does underperform. In fact, it's entirely flat performance from the FTSE 100 today. But all of the sectors are higher, including, actually, basic resources. So despite the fact that iron ore prices were not standout, we do see that sector up by 0.7%, and technology also a little bit higher, in anticipation, perhaps, of Nvidia, or maybe reacting to Nvidia's share price move yesterday. It was a strong performer into its own numbers today.
There's a possibility this morning that I'm not being very clever. What else has happened this morning in the UK?
We had some data.
We've had a CPI print that actually is a little bit stronger than anticipated. You've got a slightly stronger pound. Is that a factor that we need to fold into what is happening?
Yeah, I was thinking that, but it's only 0.1% higher, that pound move. Yeah.
But is that the reason maybe why you're getting this underperformance coming through from London? Because there's not an obvious kind of trade. If you take a look at the kind of the point story in terms of what's dragging the FTSE down, you are seeing some of the defence stocks under a little bit of pressure, but the mix is quite broad. So you've got Shell, BAE Systems, Unilever, Rexel, Rolls-Royce, Diageo, BP, all tracking a little bit low. So the oil story
is
maybe
there,
a little bit of a drag in terms of the sort of the aggregate performance, but it is compensated at the other end. Like Astra's higher. Astra's adding 4 points to the upside. On the upside when it comes to the FTSE 100, Anglo's in the mix, Barclays is in the mix on the upside as well. So there's not a kind of obvious reason why the FTSE is sideways when other markets are higher this morning. The only thing I can think of what's radically changed here in the UK this morning is a slightly stronger than anticipated CPI print.
So we've got those numbers, and we'll certainly speak to Anna Andrade a little bit later on about what those mean, those higher inflation prints. BAE Systems is an interesting one. You mentioned this as being one of the stocks that is second biggest contributor to the downside on the FTSE 100 in terms of points. And yesterday we saw all of that sector doing pretty well in the European session. So you wonder whether the defence sector has something of a trade to unwind there. Just a little, just at the margin. No denying that we're going to see a lot more spending on defence across Europe, but maybe yesterday got a little ahead of itself.
The UK 2-year, 4.44 this morning, 4.45. It's up by around 4 basis points. So we are seeing a bigger sell-off in gilts this morning than we are seeing in terms of the other European government bond market. So the bunds are up by... the front end of the German curve is up by sort of 2 basis points. So again, that maybe just speaks to, at the margin, maybe a little bit more concern when it comes to what the inflationary narrative is out of the UK.
Yes, really interesting. And I wonder the link between some of the moves in bond markets and stocks. Can stocks continue to go higher if we do see bond market yields going higher? Let's get the thoughts now of the Oaktree co-chairman, Howard Marks, who's been giving his thoughts on US asset prices.
Things are going well in the United States or better than most other places. And that's why things are high in the United States. So the situation is generally good, but you're paying a lot for it. We'd like to get a good situation at a bargain price. It's rarely the case. I don't think things are crazy high now, and I don't think it's time to get out.
OK, let's carry on the conversation. Ispek Oskar-Deskaya, senior analyst at Swissquote, joining us now. Good morning. Howard Marks is not convinced that now is the time to get out of US markets, even given the very high valuations that we're seeing right now. We've got Nvidia reporting numbers a little bit later on. Do you agree with that sentiment? Do you have to stick with this market?
Well, actually, if you're looking at Nvidia, we also expect that the results will be strong this quarter around as well. The market expectation is around $33 billion worth of sales in the third quarter. The strong AI demand, the insane demand for the Blackwell chips, and the strong TSM results earlier this earnings season will hint at Nvidia is going to announce another blowout quarter, and we actually think that $35 billion mark for sales is definitely within reach. So yes, there is reason to believe that there will be some good appetite for the U.S. stocks moving forward, especially knowing that the trade environment with Donald Trump's nomination as President of the United States just doesn't really increase appetite for the European stocks right now.
Do you see any catalysts, any reason to get out of U.S. stocks right now? Valuations are very expensive. You look at Shiller's, you look at all kinds of different metrics of the market, and they are extreme right now. But there doesn't appear on the other side of the ledger to be a catalyst to sell, to get out of this market. Do you see one?
Well, exactly. The valuations are pretty much the only concern for investors. But if you look at the U.S. markets versus the rest of the world, well, the U.S. valuations have been higher compared to the other locations for a while now. It hasn't been a turnoff for investors. And now that the geopolitical situation and the trade situation is uncertain, well, investors are not really willing to leave their U.S. darlings in order to go and adventure in other parts of the world, because other parts of the world are probably, like, if you're looking at the UK and Europe, for example, we see that it's more cyclical out there. So I think that in the current conditions, well, the US stocks are still a good place to be for investors who are willing to, well, remain invested in the stock markets.
OK, so that's the view on the US generally then, Ipek. Let's just focus in a little on those Nvidia numbers. We spoke to the CIO of Amundi earlier on in the programme, and he was saying the two things you need to watch out for here are the margin and the market share. What do you think is going to guide sentiment around Nvidia later on?
Well, later on, obviously, the margin is going to be important and the market share as well. For now, we think that Nvidia is quite comfortable for its market share. And Blackwell is going to be a very sticky point for us because these Blackwell chips are expected to generate millions of additional revenue for Nvidia this quarter and the quarters to come. Now, we do have some overheating issues that were in the news for the Blackwell chips, but I really believe that the company will really keep its focus on the insanity of demand there. And we know that the Blackwell chips are unmatched in terms of their raw power, and that's going to be a competitive advantage for Nvidia chips and Nvidia over its competitors over the next quarters.
Yes, they've talked about insane demand for Blackwell. APAC, are you nervous about the timing of delays, though? We heard just last month, I think, from Amazon Web Services talking about not getting all of the Blackwells that they had ordered until the first quarter of next year, and that seemed to cause some jitters in markets. Are you concerned about delays?
Well, obviously, it is concerning. The longer the delays, the higher the temptation to go and look up for alternatives. And we also know that AMD is about to launch two very powerful chips by the end of this year and next year. So obviously delays are never good news. But at the end of the day, many of the big technology companies, they want the best and the most premium chips. And a couple of months of delay may not turn them off or may not turn their appetite off. But obviously, if the delays get longer than a couple of months, say 2 to 3 months, that's going to be an issue, I guess.
If you are just thinking into 2025 and thinking about what next can be delivered by US tech and Nvidia, even within the US market, do I stick... The trade that I'm hearing, Ipek, at the moment is that I want to broaden out. The market is going to broaden out. Is Nvidia going to pour cold water on the idea that the market is going to broaden out, should broaden out, when it delivers these numbers a little bit later on?
Well, you know, even good-looking numbers don't guarantee an impressive rally in Nvidia shares anymore because, yes, we also do expect this rally to broaden out from Nvidia to competitors because at some point we also expect to see some slower demand from big technology companies. And it does not mean that the demand for AI will slow down, but the other sectors and other companies are maybe looking for more affordable options than the premium Nvidia chip. So we expect this Nvidia rally to broaden out to competitors and the technology rally to broaden out to the non-technology pockets of the market as well, especially with the prospects of lower interest rates from the Federal Reserve.
OK, so broadening on many fronts then. I wonder how broad your concerns or otherwise are about Chinese tariffs or US tariffs, I should say, on China. Ipek, how much does or what's your assumed timing on when those arrive to dampen expectation in markets?
Well, we are not much concerned or not as concerned as before regarding the Chinese tariffs because the tariff situation against China has been mostly and broadly priced in. If you're looking at Nvidia, for example, very specifically, in 2021, China stood for around 25% of Nvidia's total sales. Last quarter, that amount was only 12%. And so the Chinese situation is not the major worry anymore. What's more concerning is universal tariffs. If US goes and starts imposing tariffs on other countries, then that's going to be a bigger issue for the international trade and for companies like Nvidia, for example, that actually make around 2/3 of their revenue from outside the US.
Ipek, if that happens, I'm assuming that the Treasury yields are going to go higher. We're at, let's call it 4 and a bit now. We've been up at around the kind of 4.5 level. People are talking about 5. If we get to 5, does it make sense to buy bonds rather than equities? How close are we to that point?
Well, actually, I think that at 5% level, there's going to be a question to be asked between whether we would like to have a less risky U.S. Treasuries for 10 years or the S&P 500 or NASDAQ or other risky assets at the current valuations. I really believe that there is a possibility that we see that 5% level for the US 10-year yields. And if we get to that point, I actually believe that that's going to pour some cold water on the appetite that we see for the US stocks altogether, I guess.
Vincent, we were talking with Vincent. We were talking earlier, EPEC, about anomalies in European pricing, things that are just mispriced in Europe because US assets have done so well. Thinking of stocks here primarily, US assets doing so well since Trump's vote into power. What do you see as really mispriced in Europe?
Well, I don't really think that there is a mispricing. There is the right pricing of the risk because the tariffs risk is a real risk. And we also see that the European economies are struggling right now. I mean, besides the US, we also see that the German industrials are not doing well. The finances, both in France and Germany, are not solid. We have seen some political tensions in these countries. So the Europe is in a situation where the economic and the political environment is not as stable as it used to be. So I don't really think that there is a mispricing here. What really made the European stocks in a little bit better bet at the start of this year, I think, is the prospects of lower interest rates and lower yields and lower financing costs. But at this point in time, if the inflation starts picking up again, well, and if the tariff threats become, well, materialize, well, I don't really think that the European stocks are going to be benefiting from that. And we shouldn't forget that the Chinese struggles are also weighing big on the European luxury stocks, and European luxury companies are among the biggest of the continent. So I don't really think that there is a mispricing. I think that we are seeing the pricing of the increased risk both in the home markets, domestic markets, and the international markets.
Keep coming back to the idea that the market cap of the CAC and the DAX put together is not far ahead of that of Nvidia. Just to kind of put today's kind of news in context. EPEC, thank you very much indeed. EPEC Oskar-Diskaya, senior analyst at Swissquote, joining us out of Geneva this morning. Talking things that are mispriced. We'll come on to Sage in just a moment. Before we do that, let's talk about what the Core 6 looks like first thing this morning. This is the picture of the major stocks across Europe. As you can see, a sea of green writ large across the board in front of you. Novo, LVMH, Ferrari, ASML, Schneider, all higher this morning. They're up by a bit. Sage is up by a lot. Joe Easton, over to you.
So you've got this massive jump in Sage this morning, Guy. As you were saying, they're potentially suggesting it was mispriced. We're seeing it coming up even further in these opening moments, up almost 17% at the moment. It is, of course, HR software, enterprise software, as you guys were discussing with the management earlier. Now, analysts at Morgan Stanley saying there were fears around a slowdown in the core business at that company heading into these results. They've done a £400 million share buyback and also potentially signalling that consensus upgrades will be coming for that stock. So it's by far the best performing company we've got in Europe today. Then another stock doing well over in Belgium is Argenx. The trader was just flagging this one to me in my IB a moment ago, saying the company is progressing with one of their trials for an inflammation disease, and that is potentially going to be a market of around 100,000 patients that hadn't been factored into the earnings for that company over in Belgium. So a decent gain on that one as well. Then we are also watching Nokia, of course. Remember that 5.7% drop yesterday. The stock coming back up. We did get those breaking headlines, though, around a potential multi-billion-dollar contract in India. That's how the company is describing it. They haven't given specific numbers on it, but potentially that is taking the sting out of that report yesterday that the firm could be losing a contract with T-Mobile US, spurred the biggest drop in a year. We've recovered around half of that currently over in Helsinki for that one. Then in M&A, we did have that Bloomberg exclusive on Rubis. Now, this is a fuel distribution company. The share price has halved over the past 5 years, and activists are pushing for them to do something in terms of rebounding. That stock was up around 4%. It's come back down, though, potentially not getting the most of attention. Only up 0.2%. Was called much higher, but potentially we need to see more details on that one coming through. Then another one in healthcare, we've got Bavarian Nordic. Remember, this is the maker of an Mpox vaccine. It was the only approved Mpox vaccine, but there's competition concerns today because another company has got the WHO approval for their vaccine shot, and that is weighing very slightly on Bavarian Nordic today. And then staying in healthcare for this morning call on AstraZeneca. Now, that is a punchy one. They've been a long-term seller of AstraZeneca, but you'll remember Astra has slumped recently due to concern around a probe in China, and UBS saying that they think the Chinese government looks more favourably on AstraZeneca than the market is pricing in at the moment. So they no longer think you should be selling AstraZeneca today. That one coming up very slightly, up 0.4% as UBS upgrades to neutral.
Joe, thanks very much. Joe Easton from our equities team with a host of stocks that are on the move this morning. If you're wondering where Kriti is, we should mention that Kriti Gupta is in Brussels at the European Business Summit, speaking live now with the Belgian Prime Minister, Alexander De Croo. They've been talking about global trade. They've been talking about what an incoming presidency, Trump presidency, will mean for global trade, what it means for tariffs. They've also talked about the Inflation Reduction Act, the CHIPS Act, what that's done for business in the United States and what Europe can learn from that. Let's just listen in to some of that conversation.
I mean, a government first needs to decide what they do and what they don't do. A decision to say this, we're not going to do it, is also a political decision. So, and I agree with what you say. A big element of the success story of the United States, the last 20 years, but even before, is the strength of their capital markets. This is one of the main elements in the Draghi report, is that we do not have a common capital market at all. I mean, I've been finance minister in 2018, 2019. Big discussion then was the banking union and the common capital market. 5 years down the road, nothing really has happened in that domain, despite the good efforts of the finance minister. So one of the reasons is that that has become a very technical discussion, and we need to pull it away from the finance ministers, pull it back to government leaders to set the direction.
Welcome back to the opening trade. We are 21 minutes into a European session that it seems to be improving a little at the margin. US futures pointing higher as well, so seeing some upside in play here in Europe, up by 0.6% on the stock 600. Let's talk about some of the data we've had out this morning. UK inflation has accelerated more than forecast to above the 2% target, a pickup that keeps the Bank of England's officials on track for perhaps gradual interest rate cuts. Let's get more from Anna Andrade from Bloomberg Economics. Anna, good morning to you. So let's look in detail then at some of the inflation data we had out this morning. I mean, the jump in energy prices that is part of the reason here, I guess, was foreseen. What stands out to you as the surprise? Is it that, or is it the services inflation coming in a little hotter?
Hi, good morning. So that's exactly how you said it. There was part of the increase in inflation that was expected because of the increase in the energy price cap. But the bit, I think, that scared a bit more markets, which sort of leaned a bit more hawkish, was the services inflation. We had expected it to remain unchanged at 4.9%, but it actually ticked up to 5%. And that was a little bit hawkish than we in consensus expected, even though it was in line with the Bank of England. So I would say that at face value, the data does seem to be a bit more hawkish. But once you start looking at the details in the data, and you actually see that it was volatile components like airfares and accommodation that drove part of the stickiness in services inflation, then you actually have a much more benign CPI print, because once you exclude those items and other volatile items like package holidays, there was actually a fall in the underlying measure of services inflation. So that will keep the BOE easing, I think, over the next year.
I hear what you're saying. I'm reading off a Deutsche Bank note this morning. Private rents surprised them. They're up by 0.8 month on month. Airfares are up 6.3% month on month. Education fees are also quite strong as well. The problem with the argument that this is benign is that this comes before the impact of the national insurance contributions, which are going to impact the service sector quite considerably, particularly as the hospitality sector has to factor it into its thinking and potentially raise prices around that. Isn't this just the calm before the storm in terms of what service sector inflation is likely to look like?
Definitely. And I mean, by no means I meant to say that it was sort of a benign print. I was just saying that it was a little bit softer than probably the headline services inflation implied. I think you're absolutely right on the impact of the budget. I think that's one key reason why we're going to see services inflation falling at such a slow pace over the next year. You have mentioned the impact on education. I mean, we're going to have the introduction of VAT on private school fees, and that's going to take services inflation even higher. And then generally speaking, we're going to have looser fiscal policy and also the impact of the NICs and of the minimum wage, which will keep services inflation high. But I would also say that there are downside risks to that as well, because we still don't really know how the increase in these business costs are going to translate into the economy. There's one scenario where they're fully passed on to prices, and then inflation turns out higher than expected. But there's the other scenario where the opposite happens. So instead of pricing it along to prices, businesses just adjust their wage costs, and that can lead to sort of a bit higher unemployment. So it can be a bit dovish. So we're still going to have to wait and see how it plays out. But definitely our baseline is that services inflation will tick up only gradually, and that will only give the Bank of England a chance to ease, but in quarterly steps.
Anna, thank you very much. Anna Andrade from Bloomberg Economics, setting out, Guy, their expectation that we see quarterly cuts from the Bank of England, so 25 basis points each quarter next year is the sort of current assumption, but so much, I guess we lack a lot of visibility stateside, tariffs, all sorts of things. Interesting report out of the Resolution Foundation, and we talked about the flaws in the employment data in the UK a number of times on this programme, and they're pointing out this morning that they think that the British unemployment rate has been underestimated by almost 1 million people, according to this new report. The report suggesting that the employment rate has bounced back to pre-pandemic levels, worker inactivity is lower than thought, which perhaps pushes on this argument, why we are seeing some of these slight upside surprises on inflation.
So the labour market is still relatively strong, and you are seeing upside surprises on inflation. That would be a recipe you would have thought for the Bank of England definitely to sit tight and wait and see what happens, and trying to understand some of the effects that Anna's talking about there, which we still can't really compute, I think. But if the labour market is strong, and there's quite a lot of evidence around that. Certainly you talk to people kind of anecdotally within the service sector, and they talk about the fact that it's still very hard to find people to employ. You talk to a number of different kind of sectors, and they're sending a similar signal as well. It's hard to see that this is an economy that is in need of significantly easier policy.
Yeah, and you wonder whether, as we get towards the end of the year, this is the conversation that happens here in the UK and in the United States. How much easing do we really need from the Bank of England and from the Fed? Quick check on the markets then as we go to break. The stock 600 up by 0.6%. One of those businesses we've been talking to recently doing really well. Sage Group up by a considerable amount. Technology stocks up by just over 1%. Sage Group up by just shy of 16%. Coming up on the programme, the Norwegian bank DNB prepares for rate cuts and pressure on loan margins. We will be speaking to the company's CEO next. Just what preparation for rate cuts? We haven't seen them yet. Maybe they are coming, though, in Norway. We will be talking to Kirsten Braathen. That conversation shortly. This is Bloomberg. Welcome back, everybody. This is the opening trade live from London, 30 minutes into today's session. Wednesday turning out to be fairly positive for European stocks. Even the FTSE 100 now off the flat line, up by 0.2%. The stock 600 up by 0.6%. And US futures pointing tentatively higher as we wait, of course, for Nvidia, the big earnings release of the next 24 hours. Let's turn our attention, though, to central banking, to banking, and to Norway. The Norwegian bank, DNB, is doubling its target for net commissions and fees growth to more than 9%. The announcement came as the company held its Capital Markets Day in London just earlier this week. We're now joined by DNB CEO Kirsten Braathen, who's with us on set here in London. Kirsten, very nice to have you with us. I stumbled there saying central banking because it's having such an impact on what you're doing, the Norwegian central banking stance and the way it differs from perhaps what we're seeing in other Western markets right now. Kirsten, you've set your ambitions around doubling fees and commission income to above 9%. Other banks might be doing that because rates are coming down and they need to offset that with higher fees. I suppose you're doing it because you foresee that rates will be coming down at some point in the future.
I think the main reason why we're foreseeing it is related to our strong positions and activity in the fee and commissions area. More notably, we have had and we still expect there to be structurally attractive growth around savings and investment area. We've recently announced an agreement to acquire Carnegie, which is a leading Nordic investment bank. And the synergies we expect from that and the ability to capitalize on market activity is the foundation for the increased ambition level in net fees and commissions, more so than the interest-related income, which will be impacted also by rates.
And so thinking about it conceptually, structurally around your business, how big can fees get? Because lots of banks are talking about trying to increase fees and reliance on fees rather than the slightly less predictable interest income streams. How big can the fees portion be?
Well, for years we have been targeting to grow our fees faster than our volumes, and we've been able to do that. Looking at the past 5 years, the average growth rate of our total fee and commissions have actually been 6.8%. If you look at the Carnegie transaction, when we receive approval and are able to merge, that will actually lift our fee base by 30%, bringing our fee-based income above 30% of the total revenue. I think you would find others who have a larger scale of fee-based income, which indicates there's no reason why we couldn't go higher. And our fee-based revenue, more than half of it is also based on our activity outside of Norway, where we do large corporate banking and investment banking together with global positions across sectors like the maritime industry, like renewable, like seafood industries that are anchored in Norwegian competence and tradition.
Kirsten, good morning. A number of quick questions that kind of flow off that. First of all, are rates coming down next year in Norway?
The market believes, and the central bank indicates, first half next year rates would be coming down for the first time.
How far do they come? What is your perception of how far they need to come down?
Well, right now, I think the economy indicates that they are at the right level because we haven't seen reduced activity. We're heading for a soft landing, and growth is expected to pick up.
So the Norwegian
again
economy
next
can
year.
tolerate these high rates?
It has tolerated
So why
high
cut?
rates.
Why are we going to see them cut, do you think?
Well, at some point, they also will impact the activity in the economy. So, like Europe is doing, like the US is doing, at some point it makes sense for rates to come down. And expectations are for them to go from where they're today, 4.5% down to 3.25% towards the end of 2026.
And what impact does that have on the Norwegian economy, do you think? Because as you say, we can tolerate these rates now, and we're doing okay, but rates are going to come down quite significantly. So what if, is it an offsetting factor, or does it actually, do we see a stronger economy as a result of that?
We do see a stronger economy. Growth is expected to pick up again from next year, going north of 1%. One of the key drivers for this is expected to be growth in consumption. Wages will lead to growth in real wages for consumers, and corporate investments are believed to happen across many sectors as well. So there will be, again, a growing momentum in an economy which now is doing well, but also heading for a soft landing.
Kirsten, you've mentioned a couple of times the sectors that are key to Norway and the economy there, and you mentioned a small open economy, and it is small open economies that often are cited as perhaps at risk from a Trump administration, tariffs being talked about a lot. What is your expectation and your level of visibility about how any of that is going to play out over the next year or so?
Well, I wouldn't say that we have more visibility than others, and I think everyone would agree that the level of uncertainty is higher than we've been used to in the geopolitical arena for quite some time. I think the most important trading partner for Norway, so thus the most important economic area, is Europe. That's by far our largest trading partner. So, of course, there's a lot of discussions and considerations around how the U.S. economy, how the U.S. presidency might impact Europe, and of the discussions of the need for Norway maybe to go even closer in with Europe being currently a part of the EEA agreement and making sure that we are fully a part of the single market. I think that's one of the discussions that is ongoing. In general, if inflation in the largest economy in the world stays higher, rates stay higher, that would also have some impact on Norway.
That's interesting, because we see that conversation playing out in the UK with its very own different dynamics, but lots of voices suggesting that could another Trump presidency be an impetus for the UK and Europe to rebuild some of the ties that have been lost over recent years. Do you see more Europe, then, as one of the consequences of another Trump presidency?
I think that could be one of the logical outcomes. I mean,
is that what CEOs are talking about when you meet with business leaders in Norway? Does some of the conversation go to that?
Clearly. I mean, the concern, I think, for Europe, for the UK, for Norway, is future competitiveness. I mean, how do we compete in a market where there is a risk of increasing protectionism? It's scale of markets, size of markets that are becoming increasingly important in a world that is ever more about digitization and technology. And of course, Europe is together a strong economy, but the more diverse and differentiated we are, the more difficult it's going to be. So I think a stronger Europe, also from a financial and economic point of view, would be a good thing.
Do we need stronger financial institutions? Do stronger financial institutions mean more consolidation? You talked about Carnegie earlier. More?
Yes, we need stronger financial institutions in Europe. 10 years ago, the largest European financial institution was the same size of the largest US institution. Today, you need 10 European institutions to match the largest American bank.
So does that mean you need to do more deals?
Well, we would be happy to look at opportunities and grow more in the fee-related income basis. As for our universal and broad banking, for us, Norway would still be our primary market.
Okay.
And thinking about what drives the business from here, we spent a lot of time talking about, Nvidia earnings later on today, Kirsten, and just another opportunity, another reminder of the way that AI is delivering for certain sectors right now, and we wait to see how it delivers for others. How much is that a part of the conversation at DNB? How much are you factoring AI and that kind of tool into what you're offering to customers?
It's a big part of the conversation, and I always like to say that technology is as much, if not more, about people and competence than it is about pure technology. We're using AI and the new generation AI in fraud detection, chatbots, and co-coding with very promising results. And we believe in a potential transformational impact, but currently this is still a smaller part of what we're offering. But modernizing the data, making full use of the power of data, I mean, that all ties into the opportunities and potential related to AI.
Kirsten, great to see you. Thanks for coming to see us this morning. Really nice. Kirsten Braathen, the CEO of Norway's DNB. Let's carry on the conversation around what is happening with the AI story. Of course, today is Nvidia Day. Anticipation is building. We're waiting for the quarterly results to come out a little bit later on. They come out after the bell. What is the state of play when it comes to the AI boom? We're joined by Telmin Basin, who covers tech for Bloomberg Intelligence. What are we looking for?
Yeah, certainly, Guy. I mean, this is Nvidia Day, a lot of anticipation. So I think in terms of overall themes from management commentary today, we're going to be looking at where are we in this AI hype cycle. Where is demand going? Is demand sort of peaking in terms of the AI training? Is it trending towards maybe the inference, which is going to be the next wave of growth?
Yep.
And also, where are the pockets of demand coming from? Is it still the cloud service providers? Is it other enterprises which are really tumbling into this?
Yeah, really incredible growth they've seen in supplying those customers. Where are they still supplying to? What are the key things that we're going to be watching for, the things that the market is paying closest attention to then when we listen to Nvidia management?
Yeah, so we're going to be looking for guidance for next quarter. So analyst expectations are very high. They are expecting some slowdown. The slowdown is kind of all relative for Nvidia, which has been growing over 100% each quarter on quarter. So I think we're going to be looking at where's demand, where's sort of demand in terms of what chips that clients are looking for. Are they transitioning away from the Hopper towards the Blackwell? So a lot of like nuanced issues on where clients are looking to leverage their own products.
You bring up Blackwell. That's the next iteration. There's some power issues around it. There's some heat issues around it, cooling issues around it. But expectation is that we are going to see very, very strong demand going forward. How important is Blackwell, though, in this next step? I'm starting to hear talk of diminishing returns coming out of the large language models, that actually the more compute power in, you don't get the same bang for your buck. Does Blackwell in some ways resolve some of those issues? How important is this to the next step?
I think Blackwell is very important to NVIDIA. The way they sell it is, yes, Hopper was what really allowed you towards your path on accelerated computing, but Blackwell really is the next step. Blackwell does, they say, there were news reports about these heating issues, and I think investors are going to be very interested on what NVIDIA has to say. They are expecting production to ramp in 4Q. They're expecting a few $1 billion in sales in 4Q. So I think looking really closely at how management addresses these issues going forward.
Yeah, the heating and the timing of those deliveries on Blackwell, really important. What about China? Because this is an area where I think that they've dialed back quite a lot of their exposure. They've already been impacted to some degree by some of the regulation that's been brought in by the US over chips. So what do we watch for in China?
Yeah, and they have. They've really refined the way that they go to market in China. They've to address some of the US trade issues. They've really decreased their shipments to China, but it still remains a critical part of their data center business. So I think going forward, we definitely going to be looking at what they're going to say. With Donald Trump coming back into power, or is there a possibility of more escalation in these trade issues? So that does remain a critical piece for Nvidia and really for the entire tech sector.
OK, so not necessarily heard the last of the China story for Nvidia. Tamlin, thank you very much for joining us. Tamlin Basin from Bloomberg Intelligence. Coming up, we'll stick with geopolitical tensions as Russia-Ukraine tensions mount and a second Trump presidency looms. We will talk defence spending with Citi's global chief economist Nathan Sheets. Plenty of Washington experience to weigh in with there. This is Bloomberg.
You see that as soon as Ukraine is getting stronger, as soon as Ukraine could be capable now to strike back, you see what's happening in Russia. So you see this development, and also what happened with this Putin's decision about changing the nuclear doctrine. It shows that it works. So if you talk to him with a position from strength, so they're more ready for a conversation.
Ukraine's ambassador to the EU, speaking to Kriti a little bit earlier on, laying out some of the tensions that exist currently. We are watching, obviously, developments here in Europe. We're on tenterhooks, but an expectation growing that maybe even in a peace deal, we are going to see increased defence spending. So what happens in that kind of environment? Well, somebody's done a little bit of work on this is Nathan Sheets. He is Citi's global chief economist. He's a former US Undersecretary of the Treasury for International Affairs in Washington as well. Nathan, welcome. Good to see you as ever.
Good to be here.
Is more defence spending a zero-sum game?
I would like to think that there is scope, at least thinking of the Western democracies, that as we're spending more on defense, that we're providing some protection for ourselves and our way of life and defending against adverse outcomes. But if it is about a zero-sum game, the key question, and this is what I worry about as an economist, is how are we going to pay for it?
Sure, so that's what I mean.
That's the unanswered question with more defense.
If it is a zero-sum game, then you're in a situation where you've got something else has got to give.
Yes.
Does something else have to give? Is it welfare payments? Is it the what gives in a world where we see higher defence spending?
You know, it seems to me that in a lot of these countries, we've cut discretionary expenditures significantly. And quite candidly, if something's going to give, it's, in my view, it's probably got to be higher taxes. But by the same token, I don't see a lot of appetite, particularly in the United States, but in other countries, for the citizens to pay more taxes. And inevitably, I did an exercise as part of this research that we've done and said, well, in NATO, as you raise defense spending, what does that do for the budget? And it turns out that it raises the budget deficit essentially one for one. It's not paid for. We're not making these tough choices. If we are going to have more defense, and I see a strong case for it, what are we going to have less of, or are we going to pay more taxes?
OK, so your research says that that leads to higher deficits, which is interesting. Nathan, good morning. So this is one of the things that obviously another Trump presidency puts firmly on the agenda here in Europe. Thinking globally, once again, tariffs, also something that is firmly on the agenda. What are you assuming in terms of the tariffs? Because we know what he said he wants to do. What's your kind of working assumption as to how extreme they are and when?
Well, I think like many others, I'm holding my breath to see what the Trump administration does on tariff policy. I don't think that we're going to see straight out of the gate 60% tariffs on China. That would be disruptive and challenging for China. But that would be equally disruptive and challenging for the U.S. economy. But I do think we will see some additional China tariffs. Could it be 15%? Possibly, but not 60. And I also don't think we're going to see, in the first 6 months, 10%, 20% across the board tariffs on all U.S. trading partners and all U.S. imports. But those threats are going to remain on the table. And I think that you're going to see the Trump administration kind of march around the world and talk to a number of our international counterparts and say, look, we want X, Y, and Z from you, where X, Y, and Z will vary. In Europe, will certainly be more defense spending, throwing this other issue we were describing front and center. But there will be demands, and it will be very transactional.
And what will his team be saying to him about the extent to which he should go ahead with these tariffs? Because even some prominent Wall Street backers who put a lot of money into the Republican Party don't like the idea of tariffs. And we're now talking about at least today's news flow around who might be Treasury Secretary. They're quite mainstream Wall Street people. They've spoken out against tariffs in some cases in the past. So what kind of advice is he going to be getting on that front?
Well, this is what, again, we're waiting to see. And I, for one, am hoping that there's somebody in the inner circle that says, Mr. President, we very much understand the objectives here and we're fully supportive of your objectives. But if you pursue this policy, these are the likely macroeconomic effects. And, that team of advisors is still being fleshed out. And I hope a person or people like that land on it. But the jury's still out. And I, like others, I'm watching closely these appointments.
But it's your expectation that Trump delivers on what he said he's going to deliver. Let's kind of run through some of the issues. What happens on immigration? Is he going to deal with that? Is he going to deal with the issue of what happens with the border more aggressively? Is he going to deal with tariffs? Do we take him at his word? Should we price that in?
Qualitatively, we take him at his word. So on immigration, is he going to be vigorous? He is going to seal off the border more vigorously.
Is that a tighter labour market?
I don't think it immediately results in a tighter labour market, largely because over the last several years, the U.S. has received millions and millions of immigrants. And I think that for now, that the labour market is amply supplied, that immigration is diffusing its way into the labor market. But over the course of 2, 3, 4 years, it certainly would if we completely seal off the border. Then there's an issue. Well, what about legal immigration? And what's his stance going to be on that? And that would be an offset if we continue to have legal immigration. But we are going to see some very visible steps and measures from Trump during these first days where he's going to implement his policies on immigration. There will be announcements on tariffs. He'll be moving to extend his Trump tax cuts probably in the first half of this year. So I think we've got to take him seriously qualitatively, even if not specifically everything he said he implemented.
And he has said on legal immigration, that we'll welcome it, but we'll see what that looks like, what that really means. On taxes, then, Nathan, I mean, what are you going to be looking for? Renewing the tax cuts that he already introduced. Anything new on that front? What should we watch for? Because this does seem to be something that, the market is all caught up in the upside of a Trump presidency and not yet focused on some of the downsides. And there's a lot of euphoria, perhaps, from the corporate space around what tax might mean.
I think that given the majorities that Trump has in both houses of Congress, it is essentially a done deal that early on, and I would think during the first 6 months, that they will jam through a reconciliation bill that will include full extension of the Trump tax cuts. And that is a significant move. You're looking there at $4.5 to $5 trillion of additional deficit relative to having them expire over a 10-year period. That is substantial. Now, could there be some other smaller measures that are also tacked on? That's possible. But I think the lion's share of the tax policy is going to be renewal of those tax cuts.
Is that nerve-wracking for the bond markets, do you think? Is that what colleagues say, Nathan?
Candidly, I think that the investors that I talk to look at the U.S. debt profile, and unlike the CBO projections, they've already factored in an extension of the Trump tax cuts. I think that it's totally in the macro baseline, and it's in investors' baseline.
OK, so that's already in.
Yes.
What gets us to 5% on a US 10-year? Because people are talking about that as being a distinct possibility. Are we going to see... Are you on board with this idea, which seems to be becoming a greater and greater tail risk, that inflation is more problematic, and as a result of which maybe the longer-dated bonds do start to rise?
Yes. Let me make 2 points here. I think of these various policies that we've talked about, the one that I'm worried the most about and where there's the most variance in outcomes is on the tariffs. And if it is more aggressive than what I described, there are scenarios where you have significant upside pressure on prices that would manifest itself as inflation for a meaningful period of time. It's the first point. But secondly, if the 10-year it gets to 5%, I would almost, and stays there, and that's the new normal, I would almost suggest that that's a world in which the Fed is not doing its job. The Fed's role over time is to bring inflation down to that 2% objective. And I don't see it get to 5% with, maybe it's the Fed's got to be so tight, and maybe it is all along the curve, and it's not, it's the real curve and not the nominal curve. But I think as long as the Fed is credible and Trump lets the Fed do its job, which is another question, right, that we'll see rates below 5. And then the question is how much.
Does it feel like a U.S. economy that needs a lot more rate cuts, Nathan?
At this moment, categorically no.
Yes.
Categorically no. And I was leaning in that direction even before the election. But, what have we seen? Strong U.S. consumer. We've seen a couple of toothier employment reports. And it's not screaming, stimulate me right now.
No.
Right?
Great to see you.
Good to see you. Thank you.
Thanks for stopping by. So more defence spending in Europe.
I think we should be ready for it.
Okay, that's the takeaway. Nathan, great to see you. Nathan Sheets, Global Chief Economist at Citi. Thank you very much indeed. We've got a lot of things coming up today. We kind of conclude with Nvidia. That's the kind of the main event. But there's a few things before that.
Let's not bury the lead then and mention Nvidia. You'll see that on in the middle of your screen there. So Nvidia earnings, that is certainly going to be... What was the stat you had earlier, Guy? That it's the combined...
If you put the market cap of the CAC 40 and the DAX together, you are basically a little bit ahead of the Nvidia market cap. So this is like the entire DAX and entire CAC reporting on the same day.
Excellent.
In terms of market cap impact.
There we are. So nothing to see here then, perhaps. ECB wage data. We'll get some of that a little bit later on today. But Nvidia is the big story. The ECB's Lagarde speaking. We'll hear from the Bank of England as well. Ramsey's going to be speaking. I think some Fed officials
after
speaking.
This very strong inflation data.
I wonder if the Fed officials think that the economy is screaming "stimulate me" right now, as we were just discussing with Nathan. An interesting one.
Certainly, the UK economy doesn't maybe need it in the same way as maybe some of the other European economies, certainly judging by the inflation data. The Qualcomm CEO is going to be joining Bloomberg a little bit later on today. Looking forward to that conversation. That conversation happens at 4 p.m. UK time. We're going to wrap up the opening trade right now. I'm going to take you through the pulse. That's the next hour. Plenty more still to discuss. We're going to be joined by the Equinor. We're going to be joined by Equinor in that hour as well. We'll talk gas prices too. That's next. This is Bloomberg.